Taylor Riggs in San Francisco in for Emily Chang, and this is Bloomberg Technology. Coming up in the next hour, the California Consumer Privacy Act. The law is now in effect, but not without controversy. We'll discuss how companies are interpreting the statute meant to standardize data mining practices. Plus, cybersecurity in 2020, what new threats lurk online, and how will tech try to thwart it? We'll talk risks to watch. And as for the Consumer Electronics Show, it nears next week, and we'll look back at the decade in tech, how tech predictions made for 2020 are not as easy as companies make it seem. But first, our top story. It was a really good start to the year for U.S. equities. The S&P 500, Dow Jones, and NASDAQ all climbing to record highs. You've Alphabet, Apple, Microsoft closing at record highs in the wake of one of the best years for American stocks in the past decade. Joining us now from New York, it is Bloomberg's Abigail Doolittle. Abigail, I joke, but it is very serious. Another day, another record high for all these big tech companies. What's driving the gains today?
Taylor, you really have to think that it's more of the momentum that we saw at the end of 2019 pushing right through. A lot of folks are talking about the fact that the fourth quarter rally, some missed out on it because they didn't expect those sorts of gains after what was already a big year, even though we had traded sideways a bit in the summer. So folks wanting in for tech, it's really extraordinary. The best day going back to October for the NASDAQ. For the S&P 500 tech index, the best day going back to September. Of course, we also had that report of the China stimulus. So we see what has happened with central bank accommodation around the world when we have these central banks supporting markets, putting liquidity into the system. Stocks respond favorably. That certainly happened in the fourth quarter around the Fed's repo action, which they're saying is not QE. Others are saying that it is QE in disguised form. But China now doing that, and it seems that stocks really responding. Again, folks wanting in on that momentum. And speaking of momentum, Taylor, this is extraordinary. You and I, over the last couple of weeks, have been talking about AMD last year up nearly 150%. Today, up 7%. That was enough, finally, Taylor, for it to put in its first all-time high going all the way back to 2000. But take a look at that long-term chart. Not really a picture of stability. What goes up often must come down, according to Newton's third law of physics. So that chart, again, not a picture of stability. But right now, investors want in on this big tech rally.
Well, and Abigail, within the volatility, you look for stability in the fundamentals. And we are quickly approaching earnings season in just a few weeks here. Let's take a look at earnings per share on a year-over-year basis, set to decline within the S&P 500. But tech and communications looks to be an outperformer. What are you hearing as fundamentals and earnings approach quickly?
That's a great point, Taylor, because I think that's what a lot of folks are hoping from a fundamental perspective, that the earnings recession that we were in for much of 2019, and certainly as you can see there, for the tech sector, that it could come to an end. Now, for the fourth quarter, it's still expected to decline a little bit for that communications and telecom sector that you were talking about. That was an area of outperformance all of last year, and that's expected to be showing growth, I believe, of 3% for the fourth quarter of this year to be reported in January. But the real area, and this is pretty interesting, Taylor, of underperformance from a growth standpoint for earnings in 2019, the chips down double digits, and in one of the quarters down 22% year over year. So this year, 2020 is setting up for easier comps. If you recall, Apple, of course, pre-announced in the beginning of last year, and we saw that ripple right through the whole tech complex. But that does, again, create easier comps for this year. We won't know that until April, of course, but that fourth quarter report coming up soon, it's going to be a real do or die moment, because if the numbers do not meet and beat, it could get pretty ugly considering how overextended conditions are.
Abigail, you mentioned 5G. There was a report out earlier that according to early adopters, 5G, frankly, isn't all it's cracked up to be. If you come and take a look at a chart here that I'm showing in my terminal, Apple, after an 85% run last year, banking on 5G and that super cycle iPhone upgrade. What if it never comes to fruition?
Yeah, that could be dangerous for sure, because this chart, when you take a look at it, it's a weekly chart. First of all, you do see a beautiful uptrend, but you also see that over the last couple of years, every 3 years or so, there's consolidation back down to that 200-week moving average. The weekly RSI, Taylor, take a look at that at 87 87.5, the highest level over the last decade. That's how overbought this stock is. Now, when you and I talk, you of course know that technicians don't mind it when it's rising, but when you start to see some sort of lower high from that 87, that could be a real danger point. And on that 5G, you're right. This past year, there were so many upgrades, a lot of bullish talk around 5G, but there are reports, the biggest adopter of 5G last year, South Korea, and then China later in the year, saying that it's a promise for the future, but not a breakthrough, and then also relatively small start. And there are no big 5G apps. Some folks are talking about that. So if it does not meet the hype that a lot of Wall Street analysts are making of it, that could be another reason to think that these overextended conditions could certainly correct, especially for Apple and some of the chip companies, Taylor.
Well, with both hype and fundamentals, it is Bloomberg's Abigail Doolittle. Thanks for joining us. Now to the battle over tech privacy in 2020. Wednesday marked the official start of the California Consumer Privacy Act. This law is meant to give users transparency on what data companies collect about them, as well as the right to block companies from selling that information. For a look at what to expect this year in the battle to protect consumers' digital lives, let's bring in Reese Hirsch, partner at Morgan Lewis, where he co-heads the firm's privacy and cybersecurity practice. And with us in New York, our own Bloomberg newcomer who covers the intersection of tech and government. So Eric, quickly remind us, what do we know so far about the California Consumer Privacy Act that just began?
You know, this is probably the most important privacy legislation in the United States today. I mean, it's an economic powerhouse. We don't have federal privacy legislation. So this is important for California companies and users in California, but also just all over the United States. And it means that companies are going to have to disclose, what data they collect to users, and then let users delete data that they don't want companies to keep. And they're also just going to have to be much more mindful about the data they retain and disclosing the data that they're going to keep to users.
Reese, what is it about CCPA that makes it, in your opinion, one of the biggest data privacy laws, frankly, that we have seen?
Well, we've just never seen a law this comprehensive regulating privacy in the U.S. And because California is such a huge market, it's going to have a large impact on national companies and the data they collect even outside of California. But privacy regulation in the U.S. has been a pretty patchwork affair so far. But this is a very comprehensive, rigorous approach that creates a host of new privacy rights for consumers that they've just never had before.
Eric, as you take a look in your reporting, you're also looking at CCPA, of course, coming into effect, but there could be some differing ballot initiatives that also pose some changes to the law. What potential changes could we be facing?
Right, so there might be a referendum in California on the ballot in 2020, which would sort of lock in a lot of CCPA and then expand some of its provisions, make it harder for California legislators to chip away at the bill. So that's one thing. Then you have, Illinois, New York, Washington State looking at bills. And then there's still this stream of, federal legislation, the idea that the Senate Commerce Committee could come up with a piece of compromise legislation that could solve this problem nationally. But, so there's just a lot of moving pieces if you're a company trying to figure out, okay, is it just about complying with the current state of California privacy law? Am I watching other states? Is there a federal law? And then what changes if there's a referendum?
And Reese, what potential changes in this election cycle on any proposed ballot initiatives do you see that could be big changes from what we currently have?
Well, the CCPA was created through a ballot initiative initially, and so it's continuing to evolve, and it's very possible that this new ballot initiative will be on the ballot in November. And it will, if anything, strengthen the CCPA and make a number of significant changes, like changing the enforcement agency. It would take jurisdiction away from the California Attorney General and give it to a new agency regulating privacy in California.
Reese, do you see California as the beginning of a federal privacy law?
Well, California has always been a trendsetter, in privacy regulation, and I think that's definitely proving to be the case already because, as Eric mentioned, there are laws in New York, Illinois, Washington, and other states that seem to take their cues from the CCPA. And I think that right now, the chances of federal privacy legislation appear to be stalled. But if you have states around the country adopting new laws that either are similar to the CCPA or take the CCPA a step or two further, you could have an enormously complex regulatory landscape for businesses in very short order. And I think if you reach that pain threshold where businesses are finding it very difficult to reconcile all these conflicting requirements, that could finally be the impetus for federal legislation.
Eric, in your opinion, what do you see as the big driver for federal legislation? Is it frankly the fact that businesses will be so confused by multiple different state laws that they really do need a federal law to lead the way?
Right. I mean, I think there are these two different tension points. On the one side, there's this private right of action or the general push on sort of consumer advocates and more the Democrats to give strong enforcement on any privacy legislation that passes. That's a key piece of debate in the federal law. So that's the sticking point. So it's how much are the states funding the enforcement, and that's part of the California referendum, like we talked about earlier. And then the other side is whether we're going to have, the federal law consume everything, basically federal preemption, and that takes over and kills sort of all the state bills and makes the federal bill sort of the law of the land. And so that's what the Republicans are fighting for in the businesses. So then you see the debate there. It's do we have federal preemption and a private right of action? Do we have neither? So that's where the debate remains. It's a lot of the small pieces of the bill people tend to agree, but it's those big sort of ideas, how we enforce it and whether the federal law is the ultimate sort of law on privacy that's still up for debate, and that's why Congress is stuck.
Reese, I'm going to try to play an acronym name and see if I can get all of these right. We were hearing that a lot of businesses didn't mind CCPR because they were already in compliance with GDPR, if you will, or CCPA and GGDR. What are you hearing from businesses just from a high level in terms of being compliant with CCPA, and if that isn't a big deal because they're already compliant with a broader level of data privacy?
Well, it's true that GDPR is a major European privacy law that went into effect last year, or the year before last. And the CCPA does draw upon a lot of the concepts in GDPR, but that's a law that applies to data of European residents. And so, it hasn't, even for big companies that have implemented GDPR compliance, they haven't necessarily done it for their US operations. And also, the CCPA has its own set of requirements and nuances. So the fact that you've done GDPR doesn't necessarily mean that you're all the way there by any means with CCPA.
Well, a debate that certainly is going to continue, along with more acronyms that I may be confused on. That is Reese Hirsch of Morgan Lewis and Bloomberg's Eric Newcomer. Thank you both for joining.
Thank you.
Now, a Cowen analyst predicts that a federal judge will probably block T-Mobile's $26.5 billion takeover of Sprint. Paul Gallen bases that on questions the judge asked during court proceedings last month. A group of states has filed suit to block the deal on antitrust grounds. And coming up, Amazon employees speak out, wanting the company to do more to fight climate change. All of that next. And if you like Bloomberg News, check us out on the radio. You can listen on the Bloomberg app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. The new year has dulled tension between some tech employees and management. An Amazon workers group says the company has threatened to fire them if they keep speaking out about the company's internal affairs. The group, called the Amazon Employees for Climate Justice, has been seeking ways to curb the e-commerce giant's contribution to climate change. For more, let's go to Seattle, where Bloomberg Technology's Matt Day is standing by. Matt, what are you hearing about what Amazon is telling employees and what the employees are saying in response?
So the employee group came out this morning with a press statement saying that they had received, some of their members had, two of them actually, emails from Amazon, legal and HR, just sort of reminding them of the company's policies about speaking to the media. This climate activist group within the company has been largely conducting their campaign to organize inside the company, but they've also been using kind of the media as a way to get their message out and kind of put pressure on the company to take firmer climate change stances. And the company seems to be sort of fighting back and suggesting that they need to go through official channels to get approval to talk to folks like us.
And Matt, this is arguably not even an Amazon story. You talk about the tension between management and employees, frankly, all over big tech. But specifically at Amazon, how did this start?
So Amazon doesn't have a reputation for employee activism, kind of the way that some of the companies in Silicon Valley do. It's more of a buttoned up, put your head down and work sort of place. But late 2018, a bunch of employees got together, sort of around, just looking around at the climate change headlines and how they were impacting Amazon's business. That summer had huge wildfires in Washington State, where Amazon is based. And they decided to take action and push the company to commit to doing more publicly to fight climate change. And since then, the company has actually taken many of the steps they would have recommended at that time.
And Matt, I want to get a little bit more of Amazon's response, talking about how their external communications policy is not new. What else are they telling you about this sort of updated communications policy?
They're basically reiterating that they don't think that their communications, or their prohibition rather, on employees going outside the house and sort of talking with their own voice on behalf of the company is new. They say a lot of tech companies do that, and that's certainly the case. Tech is pretty buttoned up when it comes to encouraging employees to kind of stay silent or at least ask for approval before going outside the house and talking about topics like this. But the employees seem to think that there is something new and different here, that Amazon is applying a policy that, while it may have existed, didn't apply to them in the months and months beforehand as they were organizing this effort.
Matt, we often hear about former Googlers, for example, former any big techer going and filing complaints with the National Labor Board, for example, or filing lawsuits. Is this a stretch too far to think there could be any legal ramifications here?
We haven't heard any rumblings of that so far as it pertains to Amazon. And I think there's kind of a fine line, at least in my understanding of the protected employee speech, relating to their working conditions versus sort of going out and claiming to speak on behalf of the company, which is, I think, what Amazon is claiming has occurred here and trying to clamp down on, at least in their ranks.
What is Amazon doing, though, Matt, specifically to fight climate change? Often I get back, I order a package and I get 10 different boxes instead of folding them all into one box to save some of the cardboard, for example. What are some of the initiatives that they have made?
So one of the earliest programs, just like you mentioned, the cardboard stack that everybody seems to have this time of year, Amazon's working to cut the amount of packaging and products they ship. And this September, Jeff Bezos announced, their CEO, a plan to be carbon neutral by 2040 and to meet the goals of the Paris Climate Accords 10 years ahead of schedule in 2030. So they're now finally making some of the aggressive commitments that some other large tech and logistic companies had adhered to climate change. And some outside observers would say in response, in part, to their employees organizing.
Well, thank you to Bloomberg's Matt Day. And coming up, what old is new again? Apple strikes a deal with an old partner. We look at the deal between the iPhone maker and its old GPU supplier. That's next. This is Bloomberg. A new year, a new chip deal for Apple. The iPhone maker striking a deal with UK chip designer Imagination Technology. The deal revives a relationship that had all but ended when Apple started making its own chips back in 2017. For more, let's bring in Bloomberg Technology's Mark Gurman, who covers Apple. Mark, what do we know about the old and the new deal?
Yeah, I mean, some context here, right? When you're building a phone or an Apple TV or a watch or an iPad, this is very much to simplify it, right? There's two main types of chips you want in those devices. You want a CPU, which is the main processor. You want a GPU, which is the graphics processor. Now, since 2014, Apple sourced GPU designs from this UK company, like you said, Imagination Technologies. They basically put that company to death a couple of years ago when they started designing their own GPUs. The company's stock price plummeted to the point where they had to sell themselves to a China-based private equity firm. Now it seems like Apple wants Imagination Technologies to come back into the fold, whether they own some patents or key technologies that Apple's not able to design itself or not paying royalties to. So they're striking a new deal with them, and it's to be seen, how long this one lasts for.
And Mark, I have to ask why, because you said in 2014 Apple went to its own chips and didn't use this company's chips. Now they're going back. Is this a new vote of confidence in the company, or worries about Apple's own chips, or none of the above?
I think it's a mix of things, right? Except I don't think this has to do with Apple, worrying about its own components. They're pretty much at this point leading the industry in terms of their own in-house chip efforts. What Imagination Technologies likely has is key patents that Apple figured it's going to need to pay royalties on anyways, and it would be cheaper for them, within a few years, the short, long run, if they just struck like a longer-term royalty deal rather than pay them on an individual device basis or deal with a public spat and lawsuit like they did with this company a couple years ago.
And Mark, what types of patents are we looking at? AI, 5G, what do we think those are?
Yeah, this is stuff related to computer vision and AR specifically. There's this new technology called ray tracing that Imagination Technologies is sort of pioneering out in the UK, which really helps with the clarity and the processing power that AR devices can have. And so some of these patents could be beneficial from that perspective as well. But also imaging technology specific to GPUs and phones and stuff like that. So they have a lot of patents that Apple could find useful. To me, in my opinion, I don't think they're actually going to use any technology straight from Imagination. They're developing it themselves in-house. They just don't want to have to pay the big bucks that royalty fees would require. This is much simpler on their bottom line.
And if they do, how soon would we start to see this into the technology? Are we looking at next September's 5G phones, or is this later off?
Yeah, I don't think this has anything to do with 5G. This would be later off. This would be AR-related technology. It's very possible this could be stuff that we're not even going to notice is new or to see. It's stuff that could already be in there. It's stuff that Imagination Technologies could be threatening to take Apple to court over already behind the scenes. Remember, this is not a public company anymore, so a lot of this can happen, sort of under the table. So it makes sense for a number of reasons why Apple would want to come to this agreement. I'd be shocked, in fact, if we saw any new big announcement specifically related to this tech.
Bloomberg's Mark Gurman breaking it down for us. Thanks for joining. And coming up, Tesla's turnaround continues as Canaccord Genuity raises its target by more than $100. We'll talk to the analyst behind the move. That's next. This is Bloomberg. This is Bloomberg Technology. I'm Taylor Riggs in San Francisco. Tesla's price target was raised by more than $100 at Canaccord Genuity. Analyst Jed Dorsheimer wrote that the trend towards electric vehicles will only accelerate in 2020. The target was raised to $515 from $375, one of the highest on Wall Street and near the street high view of $530. Jed joins us now from Boston, and from Detroit, we're joined as well by Bloomberg's David Welch. Jed, thanks for joining the program. I want to come and quickly show a chart that I'm showing here inside my terminal. 11 buys, 10 holds, 15 sells, and yet you have a great bull thesis in your note, which I read cover to cover. What is your bull thesis to get us to $515 a share?
Well, one, I love being contrarian. So if we look at 2/3 of the group being negative or neutral, I think the winning is going to be on the bullish side. But, to get into the points, when we look at coming into this year, we see many positives, and we see that the main negatives, which were largely financial based in their ability to service the debt, largely behind the company. So if we look at the introduction of the Model Y, the semi-truck, potentially Roadster, and then more importantly, and probably most importantly, the Gigafactory over in China, all of that screams positive and also suggests better profitability, which has always been the big bear thesis on this name. So it's for those reasons that we took things up today.
David, we were wrapping up 2019 with some positive news. On the final day, the Netherlands said that they had more deliveries of those Model 3s. Does it look like Tesla is on track to really achieve those annual sales targets that they were hoping for 2019?
I think they probably are, and we'll find out in the next day or so. Look, they're getting good demand in Europe, which is kind of the more surprising market. Because electric vehicles, kind of, from the native automakers there, just hadn't taken off quite as well. But Tesla's doing pretty well there, and I think you're going to, in 2020, see more action from China. So, look, I think they'll probably hit their target for the year, and then they do have pretty good momentum. The bigger question, I think, for investors is, can they consistently make money with these cars, particularly as they start to sell cheaper versions of their models? That'll be the big question for a lot of investors, and whether the bulls or the bears win out on this one.
And Jed, I want to go down and sort of break out your thesis piece by piece, starting with the top line, just those annual deliveries. Are you confident that they have met those in 2019?
Yeah, I am. I think 2019 numbers, so we're at 368. They've given guidance for 360. I think those numbers are doable. I was going to jump into the profitability because I think there is a really important point to hammer home that kind of leads us to this bullish stance around profitability too.
So Jed, come and take a look at a chart here that I'm showing inside my terminal, because a lot of the bull thesis and the consensus I've been hearing around Tesla has been, frankly, betting on China. China demand has to be there. The problem is you're looking at sort of a decline in what has been the EV market over in China. Is there enough demand for Tesla to combat what looks like strong headwinds in the overall Chinese auto market?
So, first off, I think the short answer is yes, but we'd have to take a step back and ask ourselves, why are we going over to EVs? Our stance here is very bullish. And the reason, when you look at an ICE-based vehicle, you have less than 20% efficiency in terms of energy in versus desired output out. When we go to electric, that bumps up to 75%. It was the same thing that we saw in the lighting market when we went from incandescent light bulbs to LEDs. You saw a material shift in efficiency. I think you're going to see the same thing here. So when we look at the 75 or 80 million vehicles sold, EVs are still only 2% penetration in terms of that number. There's a lot of room for growth there. Further, when we look at profitability, as David was saying, I think the point isn't just China. The point is 3 and Y. They share 75% of the same platform. We've never seen that before. The S and X only share 25% of the same platform. So if you see the shift when you go from these low volume, high price vehicles that had little overlap to high volume, lower priced vehicles that have a lot of overlap, that is suggestive of greater profitability increase for the company. That, I think, is a real important point.
David, some of the concerns I've heard is the 3SXY, Cybertruck, they're all going to be cannibalizing sales, not producing new potential buyers. David, what are you hearing about that?
Look, that's a real possibility. Although to Jed's point, I think there is a lot of real growth here. I mean, his point that EVs are 2% of the market does give it a lot of room to grow. So there are just a lot of people who want an EV, and as they come up with more body styles, I think they'll get the growth there. I still do wonder about profitability, because the big question about Tesla has always been execution. Can they manufacture efficiently? Can they get battery costs down? Can they do all of this stuff on time? And that's been the real problem for Elon Musk and his company. Look, if this were a conventional automaker and they were sharing a lot of parts and platforms and making 3 different vehicles using 75% shared parts, I'd say, yeah, they're going to print money. But this is Tesla. They've never proven they can print money, so I think a lot of people will take a real wait-and-see attitude on that.
Well, both of you are talking about profitability, so let's go there right now. And the story of the year, if you look at this chart, was last quarter. That surprise profitability that came in much higher than analysts were expecting. So, Jed, the one concern is cutting their way through the margins, through that income statement, down to get a boost on the bottom line. Can they continue to cut their way to profitability, or do they need a new strategy?
So I think they can, and I think that's what we're seeing, and frankly, that's what we're betting on. But just to David's point, I think the most important data point didn't come from Tesla for Tesla. It came from their rival Porsche. You've got Porsche, with a preeminent brand, with the Taycan at 2 times the price of the Model S, with half the range, with the same battery pack. I mean, there is still it's not, when we look at EVs, it's not as simple as just tossing some battery cells and tossing a motor and inverter into the vehicle. There is some differentiation in terms of, and what Tesla has shown the ability to do is to monetize that range. You can either do that with price or you can do that with longer range. And both are valuable to the consumer. In fact, I would argue that that is the most valuable thing to the consumer. And it would be akin to coming out with a vehicle that gets 2x the miles per gallon as their competitor. And that was from one of the largest largest manufacturer in the world.
Well, Jed Dorsheimer taking us from a 4:30 to a 5:15 of Canaccord Genuity and Bloomberg's David Welch. Thank you both for joining. And coming up, CrowdStrike has been named the top security pick at Needham due to its 2020 potential. We'll talk to Needham senior analyst Alex Henderson behind that call. That's next. This is Bloomberg. New year, new threats. Cybersecurity trends in 2020 are including new mobile risks. In addition, hackers are also expected to employ machine learning in attacks, and the cloud will prove fertile ground for compromise. Let's bring in one of the most renowned experts in the field. It is Tom Kellerman of VMware. He served on the Commission on Cybersecurity under President Barack Obama. Tom, great to have you here. Arguably, really, 2020, one of the biggest years when it comes to cybersecurity and the threats. How big of a year are you seeing this as all of these different threats, election, hackers abroad, pretty much come to a head this year?
Well, yes, it has become a functionality of conducting business in today's world. You have to appreciate that all the major organized crime syndicates of the world have created business models around hacking. You have rogue nation states with dedicated cyber attack divisions. And then geopolitical tension continues to manifest in cyberspace with things like the trade war and other events that occur on the global stage.
You know, Tom, I wonder who is most at risk. I talk to, cybersecurity experts, and they say it's the employees that we're exposing. The companies, other financial institutions are always a big threat. Who, in your opinion, really poses the biggest risk in 2020?
Well, I think there's a shift in how hackers are hacking. They've moved away from burglary to home invasion. It's a lot more dangerous in that they will take over and commandeer your digital transformation efforts and use your infrastructure, your website, your mobile app, and your network to attack your customers. Your brand will be used against your constituency, and that's the awakening that must be had in corporate America.
I really want to fold in the election. As you look at 2020, are we more prepared than 2016?
I would say we're more prepared because we're aware of the antics that certain nation states will leverage to manipulate democracy as a whole. But that being said, is very few states have taken up the free assistance being provided by the Department of Homeland Security to better secure their electoral systems. And frankly, many states are hamstrung with limited budgets and capabilities to do a very effective job in thwarting nation states who have malign influence campaigns that are ongoing. I mean, Christopher Wray said in a testimony in front of Congress that he sees activities by at least 3 nation states that are targeting the electoral system, not all of which have the same goal in mind.
What are the ways in which you see hackers getting to us in 2020? Is it as simple as the voting machine or something much more enhanced?
Well, when it comes to the individual or the corporation, we need to be very wary of our information supply chains, our cloud service providers, our outside general counsels, the outside marketing firms that we utilize, and even as individuals in the same regard, because those entities will be attacked and their infrastructures will essentially be jacked in order to target us and target our constituencies as a whole. But more importantly, what Carbon Black or VMware Carbon Black research has shown is that there's a dramatic uptick of destructive attacks where hackers are actually manipulating the integrity of data and changing exactly the way either a corporation operates or an individual thinks specific to their devices and their electronic and digital environments.
Tom, I love that you brought up the cloud because we have grown up thinking that the cloud is secure and safe. Is the cloud more at risk than we think it is?
Well, not all clouds are created equal. And honestly, the whole purpose behind what we are focused on here at VMware is to build in intrinsic security into the environment across the entire stack. You can't try to retrofit security on cloud environments. You have to build it in from the beginning, and you have to understand that an adversary will use that environment to attack your constituency, so you have to have greater visibility in how you would suppress that adversary in real time. So like I said, it really depends on the strategy and the amount of dedication of that organization to securing their cloud, and that varies by industry and by corporation.
Tom, you were saying that some of the biggest threats are coming from Russia, Iran, China. How are they differing in their approaches?
Well, frankly, you have a 50-year plan that's espoused by China for information dominance, and I do see that as the trade war is cooling, you'll see lesser and less attacks by Chinese hackers against American corporations, hopefully. But you see North Korea and Iran now having A-teams and cyber attack capabilities, and they're willing to destroy data. They're willing to commandeer infrastructure and leverage attacks against your constituencies. And this is compounded by the fact that, the Cold War is alive and well. And the Russian techniques are very much focused on undermining the institutions of the West and the validity and the integrity that we place upon all sorts of things from democracy to our own data.
Tom Kellerman of VMware, thank you for joining us. Now, cybersecurity tech firm CrowdStrike provides threat intelligence and cyber attack response services meant to deal with such risks. The company is also a top security pick for analyst Alex Henderson of Needham, and he joins us now. Alex, love getting your call on the top pick in the security internet space. What's behind the bull thesis?
Well, basically, there's 2 points that I would make. The first one is that we believe that the security is an area that absolutely has to see more spending. It is a primary focus, not just in terms of IT, but at the board level. And to that extent, we think that there's clearly going to be a very significant increase in spending in this space, particularly as we get closer and closer to the election. It's going to become more and more of an issue. We particularly like companies that are in the cloud direct segment of the marketplace that have a cloud-native solution. I heard your last guest talk about security in the cloud. What we want to highlight here is these are companies that are in the cloud natively that are used to protect companies directly from the cloud, as opposed to connections between an AWS, a Microsoft Azure, or something like that, where it's a cloud connection, but it's not necessarily secure. So quite different from what he was referring to. But ultimately, the reason we like CrowdStrike is we think the company's growth is going to continue to be well in excess of 50% over the course of the next year. The street has it slowing down to about 30% growth at the end of the year, and I think that that's too steep a deceleration from the 100% growth they posted last quarter. And additionally, any upside you get in revenue demonstrates significant margin leverage. So I think there's good upside to both the revenue and the margin side of the equation. We strongly believe that CrowdStrike is one of the key solutions to the security problem that enterprises are facing.
So you paint a positive picture in terms of enterprise and corporations increasing their spend on cybersecurity. But what is CrowdStrike doing specifically that perhaps other companies are not to take advantage of that positive backdrop?
Sure. So let me delineate between the winners and the losers here in the security space. We very strongly believe that the world of perimeter defense, where you basically put an IT stack at the edge of your data center, is no longer a valid security solution. While you still need to do that, that the world is shifting to what I would call a cloud direct solution. Companies like Okta, Zscaler, CrowdStrike, companies like Mimecast and Proofpoint and Qualys are in the cloud and delivering cloud security. The companies that are in the perimeter side of it, companies like Palo Alto, companies like Checkpoint, Fortinet, these companies are trying to do a perimeter defense model where you're essentially trying to keep the bad guy out, and you're just never going to win at that. There was a recent security survey where 76% of chief security officers at enterprise expected that they would be hacked in the next 12 months, and 60% of those said that they didn't think they would know it when it happened. And that's a function of the failure of perimeter defense to work. All the bad guy has to do is get through once, and you got to keep them out 100% of the time. It's pretty obvious that's not working. So we're moving to a world of what's called zero trust or cloud direct security. And these companies that are in the cloud that are delivering that, I think ultimately are the winners, will be the next generation of security companies and will gain share from the perimeter names.
Alex Henderson of Needham, thank you for joining us. And it's still ahead, Bitcoin, Hyperloop, and self-driving cars. We go through all the tech predictions of the last decade that did and did not come to fruition. This is Bloomberg. Mobile phone ownership, Elon Musk's Hyperloop, Toyota's self-driving cars, Bitcoin. They were all part of the predictions of the last decade for 2020. Many did come to fruition. Money did not. For more, I want to bring in Bloomberg Technology's Mark Millian, who joins us. Of the top 10, there were 4 or 5 that really stood out to me. One of them was 9 out of 10 people over the age of 6 will now own a mobile phone. Tell me that there's not a bunch of 6-year-olds out there with cell phones.
Yeah, I don't think that happened. Ericsson Mobility put out a report in 2014 predicting that by 2020 there would be, as you said, 9 out of 10 people over the age of 6 with a cell phone. I think they probably overestimated how quickly the developing markets would come online and how quickly cell phones would come down in price. It's just a big divide to bring so many people in developing economies up into the smartphone age.
I want to switch on over to digital because there was another prediction that Jet.com will break even. I remember I was at the Walmart shareholders meeting with Mark Lurie talking about Jet.com, but it looks like they're still losing money, not yet breaking even.
Yeah, at that point, Jet.com was an independent entity, and they were the startup funded by immense amounts of venture capital, kind of before Uber and Airbnb were really coming up and creating the age of the unicorn. And they were this early example of all of the Silicon Valley money that's going up in smoke. And so in response to a lot of the criticism, Mark Lurie came on this very network and said, by 2020, we'll be breaking even. And Walmart ended up buying them the next year, but by all accounts, I don't think that really happened. Walmart is losing a lot of money in their competition with Amazon right now.
Another one of the big tech giants that we talk about is Google, Alphabet. Now you come in and they thought that at one point their cloud business revenue would eclipse that advertising revenue, but we're not quite there yet.
Yeah, they were a little ambitious in their prediction that saying by 2020 they'll have their cloud business outpace their advertising. It's still very much an advertising business. I think at the end of last year, advertising made up about 85% of Google's revenue. And so cloud has grown a lot, but it's a far cry from what they envisioned, and they're bumping up against Amazon, which is really dominant in that business.
What might have been the biggest bust of the year, pun intended perhaps, is Dyson, saying that they would sell an electric car, and they actually came out in 2019 and I think shut down the entire business, just could not get it off the ground. What happened with Dyson? Yeah,
that was a prediction that wasn't that far out. That was just a couple years ago. They're like, all right, we're working on this electric car, and we're going to have something ready by 2020. It didn't take them long to figure out, as they described it, the project was, quote, not commercially viable. So spent a lot of money. It's a vacuum company that wanted to be something much larger and realized that it's a very complicated business.
And a very high prediction, I think a far off prediction that might not have ever come true, was Uber deploying flying cars. No flying cars in our future yet.
Yes, although they still maintain that, sometime in 2020, they expect to do demonstrations of these flying car, takeoff and landing vertically vehicles. Now they do have helicopters, which are kind of like a flying car, but not really, which they're booking in New York. But they still hope to be able to show some type of live demonstration of a futuristic Jetsons-like car.
I want to end with number 7, which is Toyota will make self-driving cars because there's been a lot of competition, not only in the EV space, but in the self-driving. Waymo, for example, also space. What did we know about Toyota and their self-driving cars?
This is actually the one that was the closest to being right. So they said that this was way back in 2015, I think Toyota came out and said, we expect to have cars that will be able to drive themselves on the highway. They will be assisted technology for drivers. It doesn't mean you won't have a driver in the front seat. And they do plan to do that this year through their Lexus brand, have a car that can drive itself on the highway, kind of like a Tesla does. But it was sort of a way to cap the crazy hype cycle that took place over the last decade in self-driving cars. There were a lot of predictions about how we'd be sitting in the back seats and have robots driving us around, and we are nowhere near that day.
Well, lots of fun 2020 predictions. That was Bloomberg Technology's Mark Millian with the latest. Thanks for joining. And that does it for this edition of Bloomberg Technology. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology and be sure to follow our global breaking news network at Quick Take on Twitter. This is Bloomberg.